The Reserve Bank is blaming population growth and slow builders for the housing bust. Let's have a look. Hello everyone and welcome to this episode of Heiser Says. I thought we'd read through this article from ABC about the Reserve Bank blaming the beginning of the housing bust on slow population growth and slow building. Let's have a look. The Reserve Bank is maintaining it is the supply of and demand for housing that has accounted for most of the recent large swings in home prices, rather than the availability or cost of home loans. Okay, so they're saying, I'll draw over here. You've got to buy your house. Here you go. And it's because there's not enough people demanding the house that the price is going down. They're ignoring the fact that loans are now harder to get for these people. They're saying that doesn't play into it. It seems odd. It seems quite strange, doesn't it? And it's just a different... once you account for the supply of money and lending, debt growth, you get a different picture of the economy. And North has done a lot of videos on these type of things, and I'd suggest you look him up. So let's keep going. The bank also remains deeply concerned about the low level of wages growth, saying that it is more likely to be damaging to consumer spending and the economy than falling home values. Well, yeah, probably, because if your wages don't grow, you'll start cutting back, particularly if you're concerned about falling house prices. I think it works in conjunction. Psychologically, if your house price goes up in value, you're more likely to spend more money. You're more confident. It's all to do with confidence, really. Speaking at the AFR's annual business summit, RBA Governor Philip Lowe said property price falls of the scale seen in Sydney and Melbourne over the past year to 18 months have been seen before. Declines of this magnitude are unusual, but they are not unprecedented, he said. In 2008 and 2010, prices fell by a similar amount as they did on two occasions in the 1980s. In the 1980s, the rate of CPI inflation was higher than it is now, so in inflation-adjusted terms, the declines were larger than the current ones. Okay. Dr. Lowe pointed out that in contrast to previous housing market falls driven by weaker economic conditions and rising interest rates, neither had caused the current downturn. The origins of the current correction in prices do not lie in interest rates and unemployment, he observed. Rather, they largely lie in the inflexibility of the supply side of the housing market in response to large shifts in population growth. I think that would have more to do with the local planning authorities not allowing the market the freedom to adapt. But Dr. Lowe said low interest rates, insanely low interest rates, and government policies supportive of investors such as negative gearing and the 50% capital gains tax discount did add to speculative demand once prices were on the way up, magnifying the price rises. The strong demand from investors had its roots in the population dynamics, he argued. RBA says Hayne not to blame for house price falls. Many analysts have attributed a large part of the responsibility for house price falls to tighter lending standards, but Dr. Lowe downplayed this effect. The RBA liaison suggests that, on average, the maximum loan side offered to new borrowers has fallen by around 20% since 2015, he said. Yes, wouldn't that relate to it? Even so, only around 10% of people borrow the maximum they are offered. Sensibly, most people borrow less than what they are offered, so the effect of this reduction in borrowing capacity has not been particularly large. We'll see. There was a recent article in Melbourne about, 4,000 parcels of land that are now up for sale because the original contracts are falling through. If you look at contracts see, he's looking at maximum borrowing capacity and saying, oh, people don't borrow maximum, so it's not going to affect it. What you should be looking at is contracts falling through, is the number of contracts that fall through due to financing. That would give you a more accurate measure. Because regardless of how much you can borrow, if they have new ways of measuring your spending, new restrictions, some banks don't even want to lend more money into certain buildings. It's all about risk management. Despite this, Dr. Lowe admitted that some banks may have gone too far in tightening their home loan applications processes. This means that credit conditions tighten more than were probably required. Now, as lenders continue to seek the right balance, we need to remember that it is important that banks are prepared to take credit risks, he added. Well, they're in the business of shifting credit risk. Dr. Lowe said ultimately the fall in house prices would end when enough owner-occupiers saw value in the market, with investors likely to be sidelined for some time yet. Over recent times, the number of people reporting that an investment in real estate is the wisest place for their savings has fallen significantly. So it is not surprising that there are fewer investors in the market, he observed. At the same time, the number of people saying it is a good time to buy a home has increased. Low prices draw more people in, and eventually this helps stabilize the market, so it is worth closely watching these shifts in sentiment. Car dealers and furniture sellers feel the brunt of housing downturn. Dr. Lowe said a key area of interest for the banks was what effect the fall in house prices might have on consumer spending, which makes up around 60% of the economy. The so-called wealth effect, as I mentioned, as the theory goes, when asset values rise, people who own them feel richer and become more willing to spend, which can work in reverse when asset values fall. The RBA governor said, staff at the bank had done economic modeling to try and estimate the effect. They estimate that a 10% increase in net housing wealth raises the level of consumption by around 0.75%. In the short run, by 1.5% in the long run, he revealed. The wealth effect appeared to be showing up in some economic data, with new car sales falling in 2018 and motor vehicle imports slumping in recent ABS data. However, Dr. Lowe added that the so-called wealth effect may not have increased spending as much while house prices were rising on the East Coast over the past 5 years or so, and therefore may not lower spending as much as real estate values fall. What do you think, guys? I suspect it will have much more going down because it's a negative framing and negative psychological concern. I think it would actually have more of a slump. You know, say you get 1.5% up for good times, I'd argue to get 1.75 or 2% down when people start getting worried because it's negative. It's that simple. What do you think? Let me know in the comments what you guys think. Over recent years, households have been injecting substantial equity into housing and have not been using the higher house prices to borrow to support their other spending, he observed. This is in contrast to the period around the turn of the century when households were withdrawing equity. Dr. Lowe said a big effect on consumer spending may come from workers who no longer expected the size of pay increases they used to get and are not unwilling to run down their savings further in the hopes of a bigger paycheck in the future. As the period of weak income growth has persisted, it has become harder to ignore it, he said. Expectations of future income growth have been revised down, and it is likely this is affecting spending. Modeling the worst case scenarios. Nonetheless, it is clear the Reserve Bank has seriously contemplated the ability of Australia's economy and financial systems to withstand a severe house price crash of the kind seen in the United States and elsewhere during the GFC. In 2017, APRA assessed the ability of Australian banks to withstand a severe stress scenario in which housing prices declined by 35% over 3 years, GDP declining by 4%, and the unemployment rate increasing to more than 10%, Dr. Lowe said. The estimated impact on banking profitability was substantial, but importantly, bank capital remained above regulatory minimum requirements. Well, that's fantastic. That means the banks wouldn't need a bailout. This provides reassurance that the adjustment in our housing market is not a financial stability issue. We have not experienced the very loose lending practices that were common in the United States before the housing crash there a decade ago, nor have we seen significant overbuilding around the country. Okay, so what has our population growth been in Australia? What has it been compared to the States? So if we have a look here, you can see 2017 we're sitting at 1.6%. Comparing that to New Zealand at 2.1, United States of America at 0.7, and they had their crash. You know, he's right. It has more. Why does it have more to do with lending in the United States, but not here with a tightening in lending? So it seems like they're ignoring an aspect, or they're downplaying it. They need to look at the rates of contracts falling through. I don't have time to find it now because I'm about to go looking for an apartment today. But if anyone knows it, let me know in the comments, please. So you look at our population, we're at 24.6. Our fertility rate still is under replacement. we need to be at 2.1 to maintain our civilization. We're not. We're at 1.8. So we're going down. We will go down. Most of the Western world will go down because our population rates are not at high enough. It's that simple. So I don't know what he's talking about, to be honest. I don't know. I think it probably has more to do with lending and local authorities not allowing the market to adapt to needs of the community. Let me know what you think in the comments, guys. How are you preparing for this coming housing crunch? Take care. I'll see you all next time. Bye for now.